Good morning. I'm Tom Cosgrove, Senior Vice President of Public Affairs and Knowledge Exchange here at Farm Credit East, and we appreciate everyone joining us for today's webinar. With us here today as well is Chris Lawton, our Director of Knowledge Exchange. So the subtitle for this 2017 Dairy Outlook webinar is, what will 2017 bring? And obviously that's a complex question, because as we look back at what the last few years have brought, it's been a mixed bag. In 2014, we had record prices, followed by a steep decline into 2015, as well as some milk marketing challenges in 2015 and 16 that we hadn't seen in some time. Last year, prices were lower still, compounded by a drought in many parts of our region, but prices have been on the rise in recent months. So there's a lot to sort out here, and to tackle a complex question such as what will 2017 bring takes a team effort. And we're fortunate today to be joined by a team of experts to walk us through this today. So on the screen is an outline of today's program, and leading us off will be Dr. Mark Stephenson. Mark is the Director of Dairy Policy Analysis at the University of Wisconsin-Madison. Mark's a Michigan native with degrees from Michigan State and a PhD from Cornell, where he spent 19 years in the faculty. He's joined us before for our Dairy Outlook webinars, and we're glad that he's been able to join us again this year. Next, we're going to hear from Jodi Smith. Jodi Smith is the Senior Dairy Markets and Policy Analyst for Upstate Niagara Cooperative, and she's going to provide a regional perspective on the dairy market outlook. Jodi's originally from West Virginia and has a BS in agribusiness from West Virginia University, a master's from Arizona State, where she was a USDA fellow, and currently she handles a variety of roles at Upstate Niagara, including milk forecasting, the Producer Risk Management Program, and coordinates their Young Cooperator Program. So great to have you with us, Jodi. And while our first two speakers are going to be focused on the dairy market outlook, it's also important to consider the outlook on the regulatory front. And an important part of that is what's going on in environmental regulation and nutrient management. So to give us an environmental update, as he's done before, we're pleased to welcome back Karl Czymmek. Karl is a Senior Extension Associate with Cornell's PRO-Dairy program. And Karl has degrees from Cornell and a law degree from the University of Buffalo. So Karl, we're glad you could join us again this year. And following our presentations, we're going to hear from two of our farm credit veterans, both of whom have worked closely with dairy producers on both the consulting and the lending sides of our business. So we're going to look forward to hearing from Brian Monckton, our Western Region Manager, based out of our Batavia, New York office. Brian's a member of our senior management team and our senior loan committee. And his region is home to a high percentage of Farm Credit East dairy loan volume, so we look forward to getting his perspective. And we're also going to hear from Bill Zweigbaum. Bill's a Farm Credit East business consultant. He's been in dairy production himself. He has a master's in dairy science from Virginia Tech and has worked at UNH Extension, so he certainly brings a well-rounded perspective to the discussion. So before we get started on our presentation, I want to just provide a quick disclaimer on behalf of Farm Credit East and our presenters that this presentation is not intended to be relied upon for investment, tax, or legal advice. And so with that, I'm going to turn it over to Dr. Mark Stephenson for his presentation.
Then let's get started. You know, this year I thought I'd begin at a place that I don't usually spend too much time on, but I wanted to talk just a little bit about domestic consumption of dairy products. We've had a number of high-impact trends that have been occurring over the years, and I thought it's worthwhile just pointing out a few of those. These four big categories that we have of dairy products, American and other cheeses, yogurt, and butter, have all been product categories that have been increasing in consumption over the past many years. In fact, I'm showing about 40 years worth here. You may also notice on here that this is denominated in pounds of the actual product per capita. It's not pounds of milk equivalent or anything like that. So since cheese has roughly 10 pounds of milk equivalent per pound of cheese, then you can imagine what those kind of consumption numbers are on a milk equivalent basis. But we've got a few things to look at in a screen like this. One, yogurt consumption. Great for the Northeast. You can see has had an obvious fan of greater consumption over the last several years. Cheese has been this bright star of the dairy industry over a 40-year time period and has grown last year to the point where we breached the level of 35 pounds of cheese consumption per capita in the United States. That puts us in kind of an elite status with other countries, but lest we think that this is just about as much cheese as people can eat, we have a couple of other examples, such as Germany and France, where per capita consumption of cheese is more like 50 pounds. So we've got some headspace for continued growth in that category. And then finally, an old staid product that didn't look like it had that much life in it is butter. And a couple of years ago, we had butter that was declared to be not so bad as the medical community thought it was for the previous many years, and that seemed to be the license that consumers needed to say, great, bring it on. Last year, butter consumption was up almost 8% per capita, and I think it's going to be close to that number again in 2016 by the time we get the final data in. So these are high impact trends, this strong domestic consumption of dairy products. We have high impact trends, though, for a couple of product categories that have been going in the other direction. Fluid milk is an old story for us. We've seen sales that have been diminishing over quite a long period of time, and even our ice cream and frozen milk category novelties have been declining in consumption. So these have been trends that are offsetting somewhat the more positive notes that we had on the other dairy categories. In order to kind of sieve this out and say, well, what's the impact on farm milk usage, we can look at this across all dairy products and see that our consumption pattern here in the United States is a good news story. We've been generally increasing in milk consumption per capita over a long period of time. We add just about 2 pounds of milk per capita per year. So you know, dairy product consumption is up and has been increasing. That's a good news story for us all. The other part of the trend in terms of domestic consumption of dairy products is that our population keeps growing. This is the population through the last year, and you know, it looks almost like you just put a ruler on there and drew a line. It is so linear and regular that we add about 3 million people to the U.S. population every year. Well, of course, we can take both of those two trends, you know, of population growth and per capita consumption growth, and if we look at what the needs will be for milk next year, it would say that we need about an extra 2.5 billion pounds of milk just to satisfy our domestic growth needs. So that's kind of a good news category or story. We want to look at a couple of trends, I think, on the other end of this, and that is on the supply side. We've also had a really high impact in looking at the efficiency of milk production on farms, the pounds of milk per cow per year. It is also an incredibly linear trend, one of the most linear trends that you can see in a modern agricultural system. Trends like yield on corn or beans or other things tend to be much more up and down. This has a few wiggles in it, but it is a very linear trend that says we increase milk production per cow about 284 pounds per year. You know, if we take this kind of increased productivity out here and look at the consumption needs for the domestic marketplace here in the U.S., it would suggest that we need about 8 million cows in the U.S. dairy herd to supply our domestic needs, including growth that we would have in the year ahead. But, you know, our milk production per cow is very linear in its nature over a long period of time, but it does change a little bit from one year to the next. There's certainly a seasonal pattern still to our production, and you'll notice in 2016 we've had a greater than average increase in milk per cow. This is partly because the year before, 2015, we didn't express very much of the increase, no part due to lower prices, but also feed that wasn't as readily available. So milk production per cow has had a tremendous strong burst this past year and has been most of the increase that we've seen in total milk production. But our cow numbers have been really quite flat. They've inched up a little bit, both over 2015 and over 2016, but nothing like the green line that is showing you the 2014 increase in cow numbers. That, of course, was a response to that really strong milk price that we had in that year. That is a market signal telling us we need more milk, and farmers put cows on and increased production per cow to get us more milk, which was probably a little bit of an overshot for us and resulted somewhat in the price crash that we had the last couple of years. But if we take this increased milk production, as I said, we need the milk from about 8.1 million cows to supply our domestic needs. But if we take account of both imports and productivity increases, we really would need about 1 million fewer dairy cows in this country. So into that breach steps exports, and that's the reason that we've been able to have continued growth in cow numbers and productivity at the kind of pace that we have. This is a chart that's showing you what both the imports are in the red line and the exports in the blue line. And exports and imports here are expressed as a percentage of total milk production in the U.S. In about 2005 was when exports really began to jump for us and diverge from a long-term pattern that we had. And we've had increases through most but not all of the years there. You can see for sure 2009 time period when we had reduction in those exports, that dairy products stayed home. And in the last couple of years, 2015 and 16, we've also had a decline in from the peak that we had in exports of dairy products. But we've got a little bit of an uptick going on now. I want to show you something, though, that I think is part of this high impact trend that we've been talking about, and that's going to relate this export line to milk prices. This line or graph is showing you that same blue line, which is exports, but this time around I've superimposed the U.S. all milk price on that same time period and measured off the other axis. And I want you to look at what has actually happened during a few key time periods. We've had time periods when we've had fairly major price drops. You can see over there in 2003 a fairly big price drop. Same thing in 2006, 2009, 2012, and most recently 2015-16. But if you look up above that, you'll notice that every single one of these time periods also corresponds to a time period when we lost export sales. Export sales either declined quite a bit or they were relatively flat, as they were in 2012. Slight decline there, but it certainly had a push down on prices. So exports are really important to the U.S. dairy industry for continued growth in milk production, and I think you can also see what kind of story we would have if trade became a big issue for us and kept a fair amount of those exports here at home. We simply would have to figure out how to ratchet ourselves backward. The milk price is part of the story, but in years like 2012, it wasn't the whole story. It also had a lot to do with the cost of producing milk in that particular year. We've had a lot of volatility, but now it's been something that we've tried to talk about more in terms of a margin rather than just a milk price. For some farms, the milk price is the most important volatility piece, but for other business models where you're purchasing most of your feeds, then the feed price matters a great deal too. And you can see the volatility here even in the MPP margins calculations going back to the year 2000. I'm forecasting right now that we're going to have a very much stronger margin next year, something that's going to average really close to $11, much more than the $8 that we averaged this year. So a big improvement in margins. And of course, it's not just going to be the milk price forecast, it's also what's likely to happen with the feeds. This is showing you that MPP ration value, the value of the ration to produce 100 pounds of milk from a dairy cow. And you can see the fluctuations that we've had. In 2009, we had a little bit of a burst, or late 2008, early 2009. That was high oil prices. 2012 was still a continuation of relatively high oil prices, but also drought. And since that peak period in 2012, we've been declining, and feed prices are relatively low again now. We're down to about a below an $8 range at least on the ration, and close to $7 in most parts of the country. So the margin's been good. But as I mentioned before, the margin or profitability on farms is really a signal to dairy producers telling them how much milk we need. And we do respond to this. 2014, big margins, and you'll notice there that we had milk production increases that were as much as 4% in the U.S. above year earlier levels. Big decline since then as prices declined. We are increasing again now, but our normal range, despite the volatility, is somewhere between a 1 and 2% increase in milk production. This, however, hasn't been occurring equally everywhere. We only have the data on all 48 states or 50 states for the first 3 quarters of 2016. We don't have the rest of the annual data yet. But if we compare the first 3 quarters of 2016 to those same 3 quarters in 2015, you'll notice that there's quite a geographic difference in where milk production's been occurring. Now, in the Mid-Atlantic area, states like New Jersey have been on decline. Pennsylvania has been on modest growth, more or less holding steady. New York has been on a really very strong increase in milk production, as have states like Michigan and Wisconsin, South Dakota, Nebraska. So we've had a number of states that have been increasing. But you'll notice if you kind of draw an arc across the United States here, you can almost split the country in half between north and south. South of that line, there are only 3 states, Texas and Georgia and Arizona, that have had increased milk production. All the rest of them, including California, have been in decline. So we've had quite a bit of difference in where milk is being produced in this country. I want to switch gears just a little bit and talk about consumer confidence in the economy and some of the factors I think may affect demand going forward. This consumer confidence number is a survey that's taken where consumers are asked how they feel about the economy. And you'll note the 2009 recession, we were feeling fairly grumpy about it, and we have since recovered pretty much to the point where we were before the recession. So consumer confidence in the economy has increased. But I want to show you the detail that underlies this often quoted value of consumer confidence. And this consumer confidence survey is actually made up of 2 pieces. One of those is the present situation. That's the line shown in blue, where consumers are asked, how do you feel about today's economy right now? The other set of questions is, how do you think the economy is going to be, say, 6 months from now? In other words, it's your expectation of the economy. And you'll notice that back in 2005, 6, 7, that time period, consumers were feeling really strong about the present situation. Felt great. But I'm concerned about the future. The green line well below the blue line. In no small part, it's just that consumer confidence that begins to nag at consumers, and they stop spending as much money as they otherwise do. Maybe they don't go out to eat as often. Maybe they don't purchase some larger luxury item that they might have done. But that loss in purchase in a consumption-driven economy like ours has a tendency to be self-fulfilling, and it plunged us in no small part down into the recession of 2009. Now, during that recession, which had gone on longer than 2009, we see 10, 11 at least, where consumers are saying, boy, today it's awful. But you notice now that the green line is above the blue line, but I'm optimistic about tomorrow. That begins to pull us up. Well, this whole story here, I guess, is to just have us take a note of what's been happening since 2015. We're once again in that situation where consumers are saying, today is great. Actually, you know, the stock market has improved dramatically, my 401k looks good, home prices have improved, etc. But I'm a little concerned about tomorrow. So I'm hoping that we don't see more divergence in this. I'm hoping that this is merely an indication that we're a little concerned with the economy and that it doesn't plunge us or start to pull us back down into something like recession, because that impacts dairy product sales. I don't think we're going to get there. Our unemployment rate is back to about what an economist would call full employment in the country. It looks good. We feel strong. And by a couple of other measures, you can see that the economy is generally in a good place. There are a couple three vertical gray bars in this graph that are showing you these plunges in the Purchasing Managers Index and the leading index of the United States calculated by the Fed that correspond with those recession time periods that we've had. We're nowhere near that right now, and so I'm not forecasting anything like recession. I think we're going to have a relatively good economy, but there's a lot of unknowns in the year ahead. Generally speaking, dairy products are a good buy for consumers. You'll notice that in 2014, these are index of retail prices for dairy products. So when you go in the grocery store, what did a basket of dairy products cost you? In 2014, they were at their peak ever. As farm prices dropped through 2015 and 16, so too have retail prices. So we're seeing a decline there, and dairy products are a relatively good buy. And we're selling a lot of them. So that's a good thing. But I also mentioned that exports are really quite vitally important to us, and so we have to take a look at not only what we're doing but what's happening with the rest of the world and our opportunity to sell products. This graph is showing us in the red line the AMS prices for non-fat dry milk or skim milk powder, and you were seeing in the green line the Oceania prices for the same product, and the blue band is showing you Europe's prices for the same product. Now you can see that we are competitive all the time in these products. Competitive is a good thing because we sell products, but you know, we're being competitive at a much lower price level on a product like skim milk powder than we were back in 2014. So we're competitive but at a lower price level. Same thing has been true of whey prices. We're very competitive with whey prices, and we sell more than anybody else into world markets. However, those prices had been low through 2016, but you can see that whey prices have started to rebound. We're well above 40 cents a pound again now for those, and those impact rather directly the other solids value on your producer's milk check. There's a little bit different story with cheese prices. Here we're looking at the Oceania range on the green band, and again red prices are showing you our U.S. values. Well, now those prices are sometimes competitive and sometimes well above those world prices. So cheese is a product that we've typically sold sometimes but not always. And when we don't sell cheese so much into exports, then we tend to get that product backing up into our own supplies here in the U.S., and either we consume it or our stocks grow. We've had a little bit of both going on. When you take a look at American cheese stocks, you can see they've been higher than average, but in the last couple of months the drawdown has been fairly substantial, and I'm not concerned about them. I think we're going to do just fine, and we've begun to export. We have exported through much of the last 2 years with CWT assistance, and CWT for every single week of the last 2 years has provided assistance on exports for dairy products, as you've seen here in news like this from the CWT webpage. Butter has been a very different story for us. Here you'll notice that we've had time periods when our prices are way outside the bounds of world prices. That has certainly been true through 2015 and 16. Our butter sales have been strong. We've been consuming it. In fact, these price differences between our domestic price and the world have been so large that we've had quite a bit of imports of butter into this country, really only stopped as a result of some of the limits we still have on trade. But you'll notice that now we've had convergence once again of world prices as they've come up and our own domestic prices. So I think that in the year ahead we're going to be competitive with these products too. Butter stocks have been bigger than normal, but they're declining also and pulling back down into something much closer to a normal range for us and feeling more comfortable again. Same kind of story as we've had with cheese. There's an index that we look at now. It's been a trade that's been occurring for many years here, since about 2013, with Fonterra, where they have provided product to world markets on an auction. And this happens bi-weekly. This global dairy trade, it gives us a really good indication about world values for dairy products and where world sales opportunities are headed. And we hit the bottom back in 2015. We've been creeping upwards with a couple of setbacks since that time period. And I think that it's generally showing us a market that is feeling better about itself. The U.S. sales into world markets has some headwinds with the value of the dollar. Value of dollar has been very strong relative to other currencies. It makes it more difficult but not impossible to export. So I would call this headwinds, not that it's impossible for us to sell into markets with a strong dollar. But of course for sales of exports we would like to see that dollar value maybe a little lower. You know, despite all of the problems that we've had the last couple of years, our U.S. farm milk prices have held up better than most other countries. I'm going to show you in this particular slide here, the red line, what the U.S. prices have been, and I'm sorry about the units over here. These are in values of euros per 100 kilograms of milk. I'll convert that for you in just a second. But you'll notice that during 2015 and 16, the U.S. prices have been much higher than Europe's prices, and Europe's prices have been much higher than New Zealand's prices. These three major exporters have typically had farm gate prices, and by the way, these are farm gate milk prices, much closer together than they've been in the last year and a half or 2 years. In fact, the U.S. farm gate prices averaged somewhere between $17 and $18 a hundredweight, while the EU prices were about $13 to $14, and New Zealand's have been as low as $10 per hundredweight during quite a period of time. This spread was bigger than usual, in no small part because we had a strong enough economy to absorb those lost sales of exports, and the European Union had other policy tools that they used, such as market intervention, very much like the U.S. price support program was when we purchased products and stored them by governmental means and then allowed those to go back into the markets later when prices recovered. The European Union has their intervention purchases that does the same kind of thing. New Zealand had no such policy to fall back on or strong domestic economy. They rely on exports. They simply had to let the price fall to whatever it needed to clear the markets, and it's been brutal for them. This is a slide showing you the change in milk production from year earlier levels from major exporting countries. The red line in here is the U.S. You'll notice that all through this downturn in prices, we've had a small increase in milk production. Our sales have held up reasonably well, and we've never had a loss of milk production compared to the same month year earlier over this time period. The blue line is showing you the European Union, the largest exporter in the world collectively. And they had to have a big burst at the beginning of the year after their quotas had come off. But since that time, the reality of milk prices has pushed their enthusiasm for producing milk down. And starting in June of this year, they've actually had negative milk production growth and have been part of the solution to the problem. New Zealand has been a little bit up or a little bit down. In general, they're treading water. They've not had a really great year at all. Milk prices have been bad, and their milk production has not been very encouraging for them. And as far as milk production in Australia and Argentina, their production is way, way down from where it had been. The dashed black line is showing you all of these countries put together, and collectively you can see that we're producing less milk today, and we have for half of 2016 at least produced less milk than we did the same month year earlier. That's allowed us over the world to begin to draw down some of those more burdensome stocks of dairy products. We've had price cycles. I'll show you a few of these. These are actually the margin values, And the cycle is defined as being the peak price through the trough and up to the next peak price. So this 2001 through 2004 price cycle was about 33 months in length, started above $12 margin and ended above a $12 margin, dropped to $6 or so in the middle. We had something that was a little flatter but longer in the 2004 and 7 time period. This was 2009, the bad one. We had margins that dropped to very nearly $2 a hundredweight, a really bad cycle for us. And 2012 bad cycle, also close to $2, below $3 at the low point, and then recovery. This black line is the cycle that we're currently in. And I know a lot of people would like to say it's time for this to be over, but we've been in this cycle now from its peak for about 27 months. And if we were to say this is time for this to be over, it would be the shortest cycle that we've seen in all of these years. I still think we've got more room for considerable improvement and growth, and I think we're going to see that over this next 2017 year. Here are my price forecasts. And in the price forecast, in the red line, I'm showing you my Class 4 price forecast. Blue line is my Class 3 price forecast, and the green line is the U.S. all milk price. You can see strong recovery yet I'm projecting on through the first half of the year, and then a little bit of a plateau. But for me, that last quarter of the year is the year that, or the part of the year that's got all kinds of question marks about it. And the reason I have question marks about it have to do with, in no small way, what's going to happen outside of U.S. borders, not within the borders. One of the things that is got me keeping those price levels from being even more buoyant than that are the intervention stocks that Europe has. This is showing you the cumulative stocks of their skim milk powder in the blue shaded area as compared to what the U.S. skim milk powder stocks are. So our stocks are hanging right around 100,000 tons of product, very normal for us, while the European Union has accumulated more than 350,000, or about 3 times the level of stocks that we currently have. That product is going to come back on the market as the prices continue to improve, so that will have a somewhat dampening effect on the recovery. So here's my forecast in a nutshell. I think that our relatively strong U.S. milk economy is going to help us consume dairy products. I expect this to be a good year for the economy, and the dairy product consumption should follow that. World supply has slowed down, allowing world demand to begin to pull down on those stocks. We've also had a little bit of buoyancy in some purchasing, like countries like China have increased their purchasing somewhat. Nothing like they did in 2013 and 14, but certainly better than it has been for many months. World prices are in general recovering faster than U.S. prices, but their prices have been much lower than ours. Our prices never fell so far, so I think that's a sensible thing to have happened. In no small part, this is a supply-driven recovery. It's not so much a demand-driven recovery. 2009 was demand-driven more than anything else because we had a loss of demand for exports, but that came back finally. And we'll find here that this supply recovery, I think, is going to continue, not only because the rest of the world will be slow to respond to it, but that the U.S. is probably not going to jump at it either. How fast the rest of the world responds with production, though, is the real question, and that's where I get to, we could have a much stronger milk price in the fourth quarter than I'm currently forecasting. I'm more optimistic in general than USDA is about prices. I've got Class 3 price up about $2.50, Class 4 up about $3.40, and that should bring something like a New York, Pennsylvania all milk price up about $2.65. With the possible exception that could be a little lower on the 265 if premiums continue to stay tamped down in the area as they have been.
Jodi, I'm going to hand it over to you.
Well, so good morning, everyone, and thanks again. Dr. Stephenson, I think he did a really wonderful job on the current situation and outlook for dairy. He and I actually compared notes last week, and our thoughts and assumptions aligned really well. So what I've been asked to talk with you about today is kind of the unique nature of what's going on in the current Northeast marketplace. As Dr. Stephenson mentioned, it looks like statistical pay prices to producers in 2017 are likely to be above those levels that they received in 2016. As a result, Northeast producers will likely see improved margins in 2017. A farmer would tend to likely respond to this by producing more milk. However, this price signal to produce more milk will likely be confused by price signals farmers in the Northeast may receive. Supply in the Northeast is flooding plants and outweighing regional demand and capacity constraints. Overorder premiums are being pressured lower, as Dr. Stephenson mentioned, and being passed on to producers over time. It's become fairly commonplace to hear of producers that have received lower premiums, deductions, been placed on base excess plans, or lost their markets entirely. Historically, Northeast producers could produce all of the milk they wanted, and there was generally always enough demand or capacity available to absorb it. If you look at growth in the most recent 12 months in the U.S., it's averaged a growth rate of about 1.5%. Over the same time period, growth in the Northeast has averaged 2.7%, largely driven by growth out of New York State, which has grown by 4.5%. Even as news as farmers losing markets and lower premium structures were circulating in the countryside, producers seem to continue operating under this assumption. Again, historically, this has not been an issue because our Class I market in the Northeast was very strong. If you look over the past 16 years, Class I demand has gone down 16%. But as you can see in the chart, that hasn't been a slow, steady 1% per year decline. Rather, 13% of that volume has been lost since 2011. And that period of rapid decline from 2011 and on is the period of time we're going to focus on for the remainder of today's presentation. I'll say it again because it really merits repeating. Class I demand is down 13% since 2011. In absolute terms, that's 1.2 billion pounds of milk that is no longer being demanded by Class I producers in the region. Most people's initial response would be to say, hasn't the yogurt boom offset that in decline? Well, that's quite a mountain to climb on a sheer volume per purchase occasion. But the demand for Class II milk in our market has grown remarkably. If we take a closer look, focusing on the time period since 2011, the blue bars represent Class I or fluid milk sales, which were down 13%. The green bars represent Class II sales, and Class II has grown by 14% over the period. However, in absolute terms, that's about 830 million pounds. Factor that into a simple back-of-the-envelope supply-demand situation, and we have a surplus of about 370 million pounds of milk without even factoring in milk production growth. Class III demands have remained fairly steady, and growth has averaged just under 2% per year, which has absorbed some of that surplus milk. However, throw in producer receipts growth of 11% over the time period, and it becomes increasingly clear that we have a structural imbalance. So where is all this surplus milk headed? It's gone into balancing or Class IV. Over the period, milk flowing into Class IV has grown by 93%. Said another way, the need for balancing has almost doubled in the last 6 years in the Northeast market. Well, there's fairly strong demand for butter and a few other Class IV products, as Dr. Stephenson discussed. By and large, that is milk that is being made into products like non-fat dry milk that the market is just not demanding today. And that's when there's plant capacity even available to even handle the surplus milk. Cooperatives and processors have gone to extraordinary lengths to find homes for milk. At times, milk is cleared to the upper Midwest and as far away as South Dakota to avoid being dumped. However, it has ultimately been necessary to dump milk in Federal Order 1 as no demand or capacity was available to process that milk. And largely, farmers have been paid as if it were business as usual. This has masked any price signals that could be received by farmers as a result. And as you can see in the chart, this is not business as usual. Looking at the amount of milk dumped in the Northeast year to date, you can see the significant rise in the amount that has had to be dumped. If you factor out the average amount of milk that's had to be dumped due to quality issues or other normal activities, that's the equivalent of nearly 2,800 loads, 2,800 loads of milk that farmers worked hard to produce. Put another way, that's 7 loads of milk every day during 2016 that didn't have a home. This is truly unprecedented and challenging. Farmers aren't wholly at fault. As Dr. Stephenson mentioned, during 2014, they received what I like to think about as maybe once-in-a-generation type of price levels, and they responded accordingly to the price signal that they received. However, there's been a disconnect between what's being demanded by processors and produced by farmers in the Northeast during the same period of time. Dairy farmers may no longer be able to grow without regard to the overall market demand. It's my belief that during 2017, you'll continue to see processors, cooperatives, and other market participants make the true economic value of that surplus milk apparent to producers in some way, shape, or form. And I'll just leave you with one final chart and thought. There really is no silver bullet to fixing this issue. Some may argue that more capacity is needed. Others will argue that there needs to be contraction in milk supply. However, the answer most likely comes as some combination of both, as well as better coordination between producers and handlers. This is a structural imbalance that our market will continue to wrangle with in the near future until a better supply and demand balance is struck regionally. Yes, this is truly a difficult situation, and these are truly unprecedented times, but the market will adapt. At the end of the day, the Northeast is a great place to dairy, and there's great infrastructure here, from banking to soil and water to academia and to the services that are available to farmers. There really is no other region so uniquely equipped to tackle this issue and to continue to create opportunity for dairy farmers.
Karl, well, I'll turn it over to you.
Good morning, everyone, and thank you, Tom. I agree with Jodi that the Northeast really is a great place to be dairy farming. I'm going to talk about a few things that I'm seeing. I want to update folks on how the harmful algal bloom situation, talk a little bit about winter manure application, the New York CAFO permit, and I just want to mention some new Vermont regulations that seem to be getting some play. So with respect to harmful algal blooms, I think it's important for people to understand that we're seeing more of these in New York State. Perhaps that's because people are looking a little bit harder, but these harmful algal blooms are pretty widespread, and I don't think they're going to go away, especially if we continue to see warmer average temperatures during the summer. I think these are going to continue to happen here and raise questions for us. You can see in the slide that in 2015 and 2016, between those two dates, we had a significant increase in the number of confirmed harmful algal blooms. And then if you look to the right of that, we did have a slight increase in the number of those harmful algal blooms that have had high toxin levels associated with those. So it's important to understand that phosphorus is a key and necessary piece of supporting these algal blooms. And so consequently, that brings more focus on the dairy industry, as manure is at least one important source of phosphorus. So what does this mean for dairy farms? It's not just in New York State. Many of you have seen the slide of from satellite images of Lake Erie and the harmful algal blooms that largely are not associated with animal agriculture. There's phosphorus coming from from crop-based agriculture largely in a couple of basins in Lake Erie. In terms of harmful algal blooms, all states have a monitoring network set up. You saw the results in the previous slide of New York's monitoring effort. And all states are seeing more harmful algal blooms, especially in this northern tier of states. And as I mentioned, manure is not the only source of phosphorus, but it is an important source of phosphorus in surface waters. And I think it's important for folks to understand, regardless if they are CAFO size or not, regardless of what state they're in, listening in on this section and what their operation size is, that we're going to be have to redouble our efforts to keep manure on the land and away from the water to the extent that we can be doing that. And frankly, manure storage is going to be an important management tool for doing that in the future. Whether your operation has storage or not, that's something that I think people need to be thinking more about. So there's the other trend that I'm seeing here is there is more public scrutiny of our field practices, whether that has to do with soil erosion losses, again, winter spreading, manure storage or lack thereof, tile drains, a lot more talk and chatter about tile drains and nitrate losses, application setbacks, buffers. All of these things are getting more and more attention by the non-farm public, and I'm seeing that pop up in a number of localities around the state and region. I want to say also that the regulations are starting to reflect not only some of the science and better understanding we have of runoff issues, but also are reflecting that public interest and concern about how we go about our business of managing manure. Switching over for a few moments to the New York CAFO permit, I'm sure some of the listeners will be interested in that. I expected the permit to be out. Many of us expected the permit to be out by now. I understand that it could be any day, and although it could have been any day for many weeks now. So we'll just have to wait and see what that final permit looks like when it does in fact come out. Once that permit comes out, we will, NEDPA and Farm Bureau and DEC and other organizations will be working to set up CAFO roadshow dates, so be sure to watch your newsletters for those dates when they become available. So with that new permit coming out, it's really the decision time for folks. What permit are they going to want to get? There will continue to be an ECL or state level permit for non-dischargers, and there will continue to be a clean water permit for folks who discharge or perhaps who have the possibility of discharging. Not going to get into details in that right now. I will say that this is going to be a very farm-specific decision. I hope people will, and urge people to make that decision very deliberately. Attend the CAFO roadshow when they're scheduled. Talk to your planner. Potentially discuss the decision about which permit with a knowledgeable attorney. I do expect the permits, when they come out, to have a period of months where farms would be given the opportunity to evaluate which one they want to get into, and hope people will take advantage of that opening. A couple of new things in the permit. There are application limits and some other things. And the premise here is that lower runoff, there are lower runoff risks when manure has contact time with the soil. And so if you look on the upper right, the photo, that's an image of soil or an image of bricks that is representative of the soil. When you have soil pores that are full of water and frozen, that's not a condition where manure can come in contact with the soil. And that's one in the winter of 2014 that got us into trouble. And these new permits reflect some of the conditions that we experienced in 2014. Anyway, the new permit is going to have application limits for single applications. Regardless of what your intention for application rate is, you're not going to be able to, or you're not supposed to saturate the soil with your application. And there are conditions where the permit is going to say no application whatsoever unless you notify DEC. And that's when conditions are saturated wet, which most people try to avoid if you look in that lower right hand type of picture, but also saturated frozen, where the ground, again, is frozen solid like a block of ice. And where that new permit is not going to allow application in that kind of a condition. The new permit also expects that when the soil is frozen more than 4 inches deep or snow more than 4 inches, that farms will implement our winter wet weather guidelines. There's a link there where you can go find that document. And one of the things that's required there is an emergency spreading plan for conditions that are marginal for spreading. Another thing I want to point out that will also be new in the permit that people are going to need to think about is wet weather standard operating procedures. This is a situation where in cases where more than the 25-year 24-hour storm event is expected, that's more than 5 inches of rain as a rule of thumb, that farms would work with their planner to identify extra steps that they would take if that type of a situation is forecast. And so again, that's going to be farm specific. It's going to take some working with the planner, but things like emptying the low flow tank from bunker silos, scraping open barnyards, checking stormwater structures, maybe shifting manure to another pit. Those are the types of things that might be in a wet weather standard operating procedure aspect of a CAFO plan going forward. A couple minutes on some new Vermont rules. Again, not going to spend much time here, but what Vermont has had a set of rules called acceptable ag practices for a number of years. Well, those have been replaced now with required ag practices, and you can tell just by the change in the language and the label that things are ratcheting up there. They are being extended to all farms. If someone wants to go and look at that, they can see what Vermont farms are going to have to be doing in more detail there with those websites. This is a chart here that lays out some of the things in the timeline. And one of the things they're going to be implementing straight away, in fact, they should be implementing now, are setbacks from ditches and surface waters in certain situations, among a number of other things. So again, my purpose here is not go into a lot of detail, but just understand that Vermont is delving deeper and getting more specific about what they're requiring all farms to do. Part of the reason I put this in here is to understand that I have heard calls from some localities in New York State that New York should also adopt similar rules for all farms, not just for CAFO farms. So also want to give people, point that out to people and let you all know that so you can start to factor that into how you plan your farming operations going forward. So last couple slides here. I understand, I know that talking about manure storage is not popular in a low price period, but I think it's regardless of size and state and location, again, if you don't have storage, it may be time to start thinking about how it might fit into your operation and how you might go about getting some storage. Cost sharing opportunities take time if they're available, and there's a lot of planning that has to go in, especially if this is your first storage. Also, even if you have storage, do you need more storage? Are you often finding yourself spreading in marginal conditions? Is it time for a satellite storage option? Again, I would encourage people to think about those things. It may take a few years to get implemented, and hopefully we can get into a better price cycle in the meantime to fund some of these things. In the meantime, identifying high-risk fields, locations to avoid, as opposed to safer fields for risky conditions, would be smart operating procedure for folks, possibly working with Soil and Water Conservation District or your local planner on pile locations if and when that's necessary. If you can get manure below the soil surface when possible, that helps reduce runoff. And if you don't have a nutrient management plan, it's time to start thinking about getting one and getting it implemented. And last, I do want to close with a positive story. This picture of cover crops. I've seen a tremendous increase in cover crops as I drive around the state, especially in the Finger Lakes area. The sign there in the field, conservation at work, cover crops. I think there's no better way to tell the story to the non-farm public that we get it and that we're working hard at keeping nutrients and soil on the land than by planting cover crops and then telling people about it. So with that, that's my my story for this morning, and turn it back over to Tom.
Well, great. Thanks, Carl. A great overview, and appreciate that. Before we get to our questions, I want to turn it to our two of our farm credit staff who are on the line with us. I've introduced earlier Brian Monckton and Bill Zweigbaum. And I think first I'd just like to get kind of an initial reaction from both of you. I'll start with you, Brian, in terms of what you've heard in terms of the price forecasts and some of the other issues we've discussed.
Thanks, Tom. Hopefully you can hear me. Yeah, you know, I was kind of jotted down a couple of things as I listened to both Mark and Jodi relative to milk prices and outlook, and the good news on the milk prices is more than welcome. It's been a long, what I like to think of as 24 months probably since the decline maybe really started to hit checkbooks, and now maybe we can see some daylight there. I wrote down the word volatility, and both historically and what's likely to come. I happened to pull out July Class 3 futures here earlier this morning, and note how quickly they moved here in November. In about 45 days, they moved $2.50 roughly there, and that does make the challenge of forecasting milk prices particularly difficult. The other thing I wrote down was sort of the market signals, and how they can be conflicting maybe a little bit, and it's probably one of the reasons why we've probably got a little softer view on milk prices for 17, as premiums or assessments or whatever how that's going to flow through to the net milk check might impact that. So those were a couple things that I kind of wrote down coming out of those presentations.
Great, Brian. And before I turn over to Bill, so as you're seeing, obviously you see a lot of loans through your region and on loan committee. What are you seeing, through the last couple of years we've had, kind of a general comment on financial condition of producers in a general sense?
Sure. I think it really has been a difficult 2-month period, and I think as we gather sort of these 2016 final numbers, I think for certainly a significant portion of our customers anyway, that those will be 2 years where cash flows were inadequate. There wasn't enough money to pay all the bills, so I think that certainly comes to mind. But what we did see during that, particularly really in both years, but particularly in 16, is how quickly farmers can react and really change their operations. We're seeing their costs come down quite a bit in 16. Again, not a final number. It's too early to say for sure, but maybe as much as $2 a hundredweight. And so they certainly have taken aggressive actions there. Maybe unfortunately relative to the Northeast market, they've done a lot of that with more milk. But the other thing they did is they really cut spending quite heavily in 16 in particular, and also in 15. But that capital spend, they did what they had to do, but that was it for capital spending in 16. So we're seeing those businesses position themselves and adapt and do the things that they had to do to get through this difficult 2-year period. And hopefully looking forward to a 17 where cash flows are not red. They at least have the right color at the bottom as some black ink at the bottom for those cash flows looking at 17.
Right. Well, good. Right. And I know right now, obviously, you get some of that information in real time throughout the year, but obviously doing year-end books, and so as we put together our Northeast Dairy Farm business summary this spring. We'll get a sort of a better look. I'm sure it'll indicate some of the things you just mentioned, so that's great. So now let me turn over to Bill Zweigbaum. And Bill, I guess first I just open it to you for a quick comment on what you've heard from our presenters.
Okay, thanks. I guess the thing that really stood out to me and that I don't think can be overemphasized is that while we've got a pretty strong milk price increase projected, that we do need to look, as both Jodi and Mark indicated, at the regional situation just a little bit differently. You know, looking at statistical pricing, you see increases in the $3 range being projected by many milk handlers, and yet, as Jodi very clearly elaborated on, there is going to have to be some adjustment to that regionally in order to accommodate the real cost of moving that milk. And Mark also alluded to that by saying that for New York, Pennsylvania, he was projecting $2.65 increase. I think it behooves us to be very cautious in what we budget with, and probably to err on the side of conservatism. As I work with farmers right now, I am sticking more like to $2.25 with the belief that it's always better to have a little more money at the end of the year than you budgeted. So that was probably the thing that really struck me the most. I did also want to emphasize that through our work with the International Farm Comparison Network, which is heavily influenced by European markets, some of Karl's comments about algal blooms, you know, we sometimes don't think of that as having a direct impact on milk production, and yet in the European countries there is a movement now to begin regulating phosphorus levels on farms, and farms in the Netherlands, which are going to be impacted beginning this year, are expecting that they're going to have to reduce national cow herd by about 4 to 5% just to meet the new phosphorus regulation, which has a very severe impact on supply. Could also be very promising for price increases in the future if the Europeans continue to decline in production. But I think those things tie together more than we sometimes think.
Interesting point. And so, Bill, in terms of, so as in your role as a consultant, you're working with a number of producers. On the pricing side, what are you seeing, you know, what are some of the strategies producers are taking in terms of, you know, risk management or other things to manage that to the extent that they can?
Well, price risk management is not very heavily used, and I think if I had to try and explain why participation rates are low in the Northeast, I think it really comes down to the fact that most of our farmers are looking at the need for risk management as something that is highly related to how vulnerable they are financially. So they're looking at risk management tools really as being an insurance policy which comes with a cost, and are recognizing that if you're in a continuous mode of utilizing risk management tools, that there is a cost to that, and it does reduce your profitability because there's some slight increase to your net cost of production as a result of that additional insurance. So they're really, you know, taking the position that it depends on how vulnerable I am, how much risk I have. If I have a strong balance sheet and reasonable earnings, I may well not utilize any tools at all. If I'm heavily leveraged or just gone through a big expansion, I may be looking at those with great interest in protecting a significant amount of my milk. But for the most part, I'd say that it is still really an insurance product, and so we need to accept that, much like with our personal automobiles. As our financial position improves, we might choose to take a lower deductible on our collision insurance.
Right. So it's, in other words, in some ways, the insurance policy is a strong balance sheet to be able to withstand some of the ups and downs that come with it. That's an interesting point. So we got
coupled with a reasonable net cost of production.
Absolutely, absolutely. And so we have had some questions come in, so I'm going to start trying to get to some of those. So I'm going to turn it back to Mark for this first one. We've had a number of questions come in on the area of exports, and you know, this could it really follows a few different things in terms of, one is in terms of potential markets. You know, given that today is Inauguration Day and we have a new administration coming in, one of the questions related to potential trade with Russia. Some mentioned what's going on with NAFTA. So I guess, you know, Mark, without having you try to delve too far into the politics of international trade, maybe this would be a good time to comment on what potential markets are out there, as well as, you know, how central is that to what we're looking for in terms of the price forecast you gave us.
Yeah, you know, trade, as I indicated, is really important to the U.S. dairy industry now. It can have a tremendous impact on our prices if things go really well in a positive way, and if we have trade wars and we somehow get cut out of markets or shut down, it could have a very negative impact on our prices. And I think that it's just lots of question marks right now. I'm hopeful that some of the rhetoric that we've heard during the both the election time period and even more recently is going to be softened, or that we'll look at things closely and carefully. But, you know, for example, two of our very best customers for dairy products are Mexico, our largest customer, and Canada, our third largest customer. We open up NAFTA, and I suspect that, you know, this is going to be a bit of an issue for us. Now, admittedly, Canada did not involve dairy products in the NAFTA negotiation way back when, but nevertheless, it probably won't go really well for us there. So I'd be cautious about this renegotiation. We view trade opportunities as a very positive thing in the dairy industry. Southeast Asia has been an area of growth without question, and I think that longer term we're looking at other regions of North Africa as being a growth area for us longer term, and I suspect that some of the areas such as India in the longer term future may have possibilities for export sales. So important to us. Trade issues aside are not really something we want to kick too badly.
And while we're kind of in the area of trade, maybe I'd have to ask you a comment, a little more specific one, relative to the EU and skim milk powder. Question, two-part question really about where their stocks are going, and at which point, you know, in the EU, that, you know, as their stocks decline with their production issues, that, you know, what the impact that's going to have on milk price, you know, particularly those export product prices.
Sure. You know, I think we've seen some of the bounce in world prices, or expectations for world prices, that happened in about April, May was a turning point. And this was when world buyers perceived that we were at the bottom of these prices in the world for dairy products. And we had a number of bargain hunters, I think, that stepped in, decided that they wanted to purchase some product while it was at the lowest price it was going to be at. That's kind of a first step in price recovery. I think the place that we go next where we could see really substantial recovery is when those same buyers begin to perceive that, in fact, world stocks may be tight. So in other words, we work down some of that powder in the EU and other dairy products held elsewhere, and that the buyers may not be able to get all the product they want at those kind of prices. They begin to buy in a bit more of a frenzy, and that's when we kind of get the explosive growth in prices that may or may not be good. I mean, it's always fun to hit that high, but, you know, you tend to respond with too much milk production. So I think that's the next thing for us to look for. When do we see that more explosive buying?
Okay, and we may circle back to that one, but right now I actually want to turn over to Karl Carl, a couple questions came in specifically on your presentation. One is kind of a clarifying thing in terms of the new CAFO permit. And the question relates to, in New York in specific, the ability to grow from, is the new CAFO permit related to the ability to go from 200 to 300 cows, which is something Governor Cuomo had talked about years ago, or is this something new?
So the new CAFO permit will apply to dairies that are milking 300 or more cows, consistent with the rule change that Governor Cuomo implemented a few years ago. What I've been telling people in that, whether they're 180 or 200 or 250, if they're in that range, I will encourage people to use that time to get their processes in place, get their operation ready if they're going to continue to grow to hit that 300 number, so that when they hit 300 and they need a permit, they're largely ready for it. And in fact, the permit essentially requires that when you cross that line that you're ready to, essentially able to fully implement. So okay. That's the answer to that. If I may, I'd like to connect back to really quickly to a point that Bill Zweigbaum brought up about the Dutch. One of the great things about the industry in New York and the Northeast, the dairy industry, is that we've done a good job of maintaining a good land base relative to the amount of manure we produce. That's not the case in all production areas in the U.S., and certainly not the case in the Netherlands, where a lot of those dairies have an awful lot of cows per acre, and that's leading to the adjustment that, in considerable part, to the adjustment that Bill referenced.
Okay, and Carl, another question on your presentation with your map of the high algal blooms, noted that many of them, while many of them were in the rural parts of upstate New York, many were down concentrated near more of the metro areas, and just wondered if you could comment on that.
Yes, absolutely. That's a great point. We also see harmful algal blooms to a lesser extent, but even up in the Adirondacks, where there's no farming, people or animals, or at least not domestic animals. So you're absolutely correct. Long Island has a significant number of harmful algal blooms. A lot of that is going to be nutrients associated with human activities, and as you can see, the lower Hudson as well, a lot of that is going to be related to density of people. And so when you concentrate animals, when you have a lot of human manipulation, you have higher sources of nutrients and generally higher incidence of these algal blooms.
Okay, great. So now I'm going to turn to Jodi as we look at our kind of our regional situation. There's one here, I guess it's primarily a comment that I want to kind of read through to give a context to the next question, is that, the commenter said, well, really milk usage is growing, but Northeast balancing issues are really being driven by production increases as well as the decline in fluid milk demand. And so the comment is like, is what's needed really not just more capacity, but a retooling for really a different mix of products processing in the Northeast, which I think is a good point in terms of that mismatch. And obviously, Jodi, at Upstate Niagara, you folks are, you have members, but you're processing products as well. I just wondered if you want to comment on that in terms of, what, from the processing standpoint, what's being thought of in terms of, how we address this sort of both the short and long-term situation.
Sure. Well, I think that, everyone's taking a look at what's going on, especially the senior management and our board in the marketplace, and just trying to analyze what might be the best steps to take forward moving forward. And I think that the comment that was passed along was fair. If you look at the makeup of our market, it's largely been in Class 1 and Class 2 and more perishable type items. So if we could have some at a wish list and could go from there, there seems to be some appetite for more storable commodities, something like a Class 3 plant might fit nice into the mix in the Northeast. But, you know, it's really going to come in trying to make sure that we're taking into consideration just overall market demands and what consumers are demanding, what the world market's demanding, and making sure that we are taking the right steps to be able to meet those demands and not just to balance milk. And I think that's kind of where we're looking as we go forward.
Okay. And Jodi, we talked earlier with Mark about trade, kind of a more specific close to home issue. I asked for a comment on the current issue going on with Canada. That I know with some of the ultra filtered milk that they've created a new class, basically creating a disincentive for that product going across the border. Could you comment on that, and what impact is that having?
Sure. So I think you summed it up fairly well. Canada is planning to implement some new pricing policies referred to as a national ingredient strategy. And from what we're hearing, that's set to go into place on February the 1st. And as you mentioned, those regulations and those changes in policy and pricing are effectively meant to block the imports of ultra-filtered milk, as well as take care of a few other issues that they've got, which is their surplus of non-fat solids in the country. As a result, New York processors are going to start to see some rapid declines in the amount of demands from those Canadian processors, and this will likely push more milk back onto the market and could exacerbate some of the issues that we've already had and I discussed during my presentation with regard to continual lowering of premiums and service charges out in the countryside.
Okay, good to know. So at this point, I want to circle back to Brian and Bill to see if they've got any other either questions of their own for our panelists or comments they want to make on some of the things we've hit here during the Q&A round. Bill, why don't I start with you first, if there's anything you want to add in or touch on.
Sure. I'd like to, I guess, take a minute just to talk about some of the strategies that we've been seeing on farms that have really helped them reduce costs. As Brian mentioned earlier, you know, we are seeing pretty significant costs in reduced cost of net production in 2016 as we start to summarize some numbers here. And there's been quite a few things that are responsible for that, and probably among the bigger ones are market conditions, in that grain costs have declined due to market pressures. But in addition, we have seen farms also really analyze much more deeply the margins in everything they're doing. So they're looking at items like feed additives and fertilizer programs and saying, am I really at a point where I'm maximizing my return, or is this a place where perhaps, at least in the short run, I can make some changes that are more conducive to gaining extra margin in a low milk price environment where there's not as much bang for the buck when you make more milk. In addition, I think they're also focused in on labor efficiency and really doing a better job of evaluating capital expenditures and looking at payback periods with a much sharper pencil. Probably the other thing that really stands out among the farmers that I've been working with this year is that while we've talked to them for a long time about focusing on liquidity, as their personal liquidity has declined, they've come to recognize just how important it really is. And it's one of those cases where you miss it when you don't have it. And I think that we will see people come out of this with a new attitude towards the way that they look at future investments in the farm.
Okay, great point. Brian, let me turn it over to you.
Thanks. You know, I think you know, as we entered sort of this downturn back in 14 going into 15, we knew it was going to be a difficult period, and you know, as we're, you know, hopefully exiting it, you know, and looking for some better days, you know, I think our position, you know, is still been to kind of try to look at the longer term, to look at the margins over time of the industry, as well as for you know, any given operation. And I think back to Mark's slide there about the MPP margin, and it seemed like that number was in and around a range over time. I guess my question to Mark would be is as he looks forward, do you feel like the market is going to continue to kind of be in and around that mean number for margin, or do you feel more positive or less positive about what that margin might be as you kind of look forward?
Well, just looking back over time, one of the attractive features of the MPP margin was that it had no discernible trend to it. In other words, a lot of volatility up and down, but it didn't seem to be trending upwards. And as a means of calibrating something like payments, it felt like it was going to be a good product to use because it wasn't going to become obsolete just because it ran out of calibration. So I think it's likely that going forward we're still going to have an opportunity to stay in that kind of range, but this is talking about $8.50 as being something normal for a margin, and this next year being up around $11, $10.50, $11 would be well above that range. Even through this trough, we didn't see it get much below an $8 level. We did for a few months, but not over the annual time period. So, I'm not really sure if other costs are beginning to become so much larger that farms are not finding cost savings in different places. If so, that would mean that we'd have to rethink about the calibration of what the MPP really should be.
And Mark, while we're on the kind of the MPP, and I recognizing you're a dairy economist, but based on as we look at margins and the feed component to it, obviously feed prices have generally been lower as well. What's the outlook on that, on the feed side of it, and how do you think that impacts sort of your 2017 and forecast and beyond?
It has an impact without question. I do remember when we were at those $7 and $8 a bushel corn prices, and a lot of people saying, oh, this is a whole new paradigm. We've reached a new plateau. This is where we're going to be. But, pretty clearly our ability to produce has, once again caught up with the profit incentives that were available during those high price years. And I think the same thing is likely to be true. We may not be at a $5 level for the ration, that would have been typical back around 2000 through 2005. We're above that, but maybe this new plateau is still around that $6 to $7 level for the ration value. So it's changed a bit, but not completely.
Okay. And just a quick comment. It was noted that California, in terms of where it fell in terms of the milk production, Karl said he had actually been out there recently. With them getting some rains and snow, is that going to impact California's ability to come back online in production, or do you think there are, too many other headwinds there?
Well, the drought has been certainly major headlines for people to talk about, and it's had an impact. There's no question about it. But the California problem is a lot bigger than just drought. They have, and it's not just California, it's the whole West that has increased milk production substantially. They are very much net surplus in milk production at this point in time, and they either have to be able to push their product east and compete with the Northeast for markets over there and sales of dairy product, or they have to look west and look for exports. And I think that the real question for them is, they've got to recalibrate how much milk is actually needed in the West and how much they're comfortable producing at these relatively lower price points. So the drought is not the whole answer. They've just got a ways to go, I think, before they feel comfortable with the levels of production they're at.
Okay, great. Well, folks, we have come to the end of our hour and a half. I really want to thank all our presenters for their contributions in the discussion, as well as our Bill and Brian from Farm Credit East for joining us. You'll see on your screen we have another webinar coming up related to ag labor, so we certainly invite you to join that. And as a reminder, for if you had to miss portions of today's presentation, it will be posted on our website at the URL that's shown above. Thanks for joining us.